Okay, welcome to SB Trades, January 9th, 2023 trade plan. This is being recorded on the evening of January 8th, so Sunday night. It's about 8:45 Chicago time. Market's been open for a couple hours, and right now, market's looking like it wants to continue what it was doing on Friday. It's still early, obviously, so I'm not overly concerned, but it definitely feels like there's some levitation going on. So there's a lot of it just feels like the market wants to go higher and test these levels above. So maybe 3950, 4000 maybe. Who knows? I mean, if these things can really stretch, I mean, they can go much farther than anyone would think. Even the bulls, even people who are bullish, get surprised. This week Friday we had the big risk event last Friday, which is the unemployment number. This week we have CPI. So CPI is coming out on Thursday. Luckily, we've got a few days in between now and CPI that we can maybe do some trading, and the market could potentially be volatile, although the model thinks that there's going to be it's not going to be. The model thinks that ranges are going to compress. And that's part of the reason why I'm actually not too concerned about an offside position right now, because I don't think, for the time being, the market is poised to make big moves without a catalyst. So we'll see potentially a big move on Thursday. But between now and Thursday, if we don't get some type of catalyst in there, which I don't think there is, and someone can correct me if I'm wrong, I looked at the calendar, there's not really much between now and Thursday. Significant, unless obviously geopolitical stuff could happen, but that stuff you can't really plan for. You just kind of react to it when it comes out. So first thing we'll do is a postmortem for January 6th, the postmortem. So can't stress enough, and I think I've been doing this quite a bit, you have to minimize exposure around the major risk events. So payrolls, FOMC, inflation reports, those things are moving the market like nothing else right now. So the volatility that we're seeing, it's purely around the fact that there's uncertainty. When people don't know what's going on, when people there's something driving the market that is not available information. Now you can argue that there's people who are getting these numbers beforehand. There's an article that came out, I think Bloomberg or Wall Street Journal, talking about how in that December CPI number, that there was quite a bit of accumulation of bonds ahead of that number. Sure, these things, I'm not a conspiracy theorist, but I definitely, well, at least I don't think I am, I definitely don't think that this information does not get leaked. I think there's definitely leaks that happen. It's unfortunate. I mean, I guess there's a price for everything. But we got to trade the markets that we have, not the markets that we want. So the model that I talk about has no qualitative factors as input. So everything that I deal with is quantitative. So if it can't be measured in the market, the model doesn't know anything about it. So something like unemployment report, what those numbers come out as, or what kind of language is in the FOMC report, FOMC minutes, or FOMC press release. All that stuff is not factored into the model. Now, eventually, at some point in the future, I probably will have to factor that stuff into the model. If this model is going to survive, right, multiple years into the future, it's got to be updated. But for now, that stuff is not factored in, for better or for worse. And likely it is for worse, so we have to basically exit the market around major numbers, major releases like CPI, inflation reports, FOMC, and payrolls. Those are the three that I've identified. So ahead of something, you either dramatically reduce your size, or you just get flat, right? And that's what people are doing. So people who are in the market and they have got some capital to manage, and they've got margin that they've been allocated to apply towards a trading strategy. What they want to do is increase their Sharpe ratio. So if there's something in the market that increases variance, so they realize that their strategy does not work, or not even that it doesn't work, but the variance of the returns around certain events is increased, people will downsize into those types of events, right? They'll get out. So unless you're a HFT trader where you can really fast update your markets, so update where you're willing to bid and offer, or you've got the information ahead of hand, right? So you've got a source that gives you the numbers beforehand. You've got like if you're a person on the FOMC committee and you trade, right? I think there was a whole scandal about that last year, where people are trading with information prior to it being released. The people on the FOMC. If you're that guy, then yes, you can trade. You can be in the market. Those days are probably your edge. Like that's when you are involved, as opposed to other days where you don't have an edge. Okay, so this is kind of important to understand. For us, we don't have an edge around these types of events. Therefore, we either exit completely or we downsize our position. We basically allocate our margin to cash, right? And cash will overnight rate is whatever 4%. So we'll get something on our cash overnight. We basically, our cash goes to neutral. Neutral risk allocation for that specific day, and then we get back in the market once we have edge again. So this is kind of an important concept to understand, and I hope you guys kind of grasp that. Obviously, the market rallied massively, so SPX, everything was up over 2%. NASDAQ was up almost 3%. So we sent out a tweet, not a tweet, but a message on the Patreon about 39.26. So 39.26 was the overbought level. That's model generated. So that was a great call. We sold in size at 39.26. ES closed on Friday at 39.14, and I'm quoting ES prices right now, not SPX. So the market closed at 39.14, I think, or 39.15, around there. So right now we're still in that position, that 39.26 short. I'll look to cover that position like around 39.08, and if we didn't get there by tomorrow morning, and we're still below 39.26, I'll get more aggressive. There's a potential, and I'm aware, just to be aware of, is that the market could rally to 39.40-ish. That's where I see kind of like the next resistance level. That could happen, and it still would be in line with a longer term bearish position. There is a point, and I'm going to talk about this later. We've got that CI, relative value indicator, that we use. That is on the verge of flipping positive. So if I'm not mistaken, and I got to look this up, and actually I'll talk about this a little bit later, but there's a price, and I think it's not too far from where we're at, and I'll post this on the Patreon, where we probably would need to stop out the short. Because what that price will do, if we go above that price, that's going to invalidate the LI indicator that's been keeping us short lately. So, it sucks, but I don't think we're not that bad as far as we're decent, as far as how this short played out. I mean, we had a down move from 38.85 initially. We covered some of that. We got long. I think there was a day we got long. We got back short on Friday at 39.26. Hopefully that's going to give us a place to get out. I want to be aggressive. I want to be very nimble going in this week because of CPI. So I want to be aggressive in getting out of positions when I'm on side, right? And I'll take a loss. I don't want to have this gigantic position going into CPI because that's bad news. If I've got a position going into CPI and that the market put me into that position, yikes, right? Because the market's going to try and get you into the wrong position. The market's going to try to get you into the wrong position, and it's going to try to keep you in the wrong position. That's what the market tries to do. On top of that, when you have the right position on, the market tries to get you out of your right position before you should be out, right? So it's a sinister game. Like the market is not on your side here. It's not your friend. So you have to be aware of what is happening. So going into CPI, I'm not going to be selling as the market goes up, because that's the market trying to get me into a short position, and it's going to blow me out on the CPI number, which I don't want, obviously. Okay, so what are the scenarios? I'm just going to talk about the scenarios. You guys can read the other stuff. Well, I'll talk about the other stuff later on. But our LS indicator, which is this how many percent are we above our magnet price, which is SPX 3821. That's about 1.8% right now. So as long as CI is below zero, and it still is right now, but if we get a rally tomorrow, I'm worried that it's going to be back above zero, and that's going to call for a stop loss. Which, on the closing basis. So if we get there and we close above there. So I'm watching that very closely. That's why I want to be really aggressive with buying back this short position if we get any type of weakness overnight. So that's putting us in the short position right now. We've got some other things that, for example, this IJ indicator, which is greater than negative 7.5 right now. That's our yield curve. It's a yield curve equity volatility metric. So it's using the yield curve to measure equity index volatility. Okay, so that's a proprietary metric that we use. It's really good. Right now, it's hovering around zero, which means that we don't expect much equity volatility. Again, this is we're not looking at event risk right now. We're looking at beyond the event risk, right? So I don't expect a massive move tomorrow. Whether it's up or down, I don't expect a massive move. I still think the model's still saying that we should come off. We should go down here. I'm not expecting that to the market to push me offside too much on this short position. But again, if it comes off, if we get any weakness, I'm buying in that short because I want to stay nimble. I'm not trying to accumulate anything right now. Okay. We also on that rally, because of that rally on Friday, CM is greater than 2 right now. So thanks to that rally. On top of that, we've got FI equals -1. FI equals -1 means this is the unfiltered signal, the unfiltered model. FI being at -1 means that that unfiltered model wants to be short. So when we have CM greater than 2, and that's because that's basically measuring the one-day move. It's a spread of the one-day move versus CI, which is the trend move. Okay, so that spread spiked. So we're way ahead of trend right now. Okay, so price rallied really far ahead of trend. So even if we got a mean reversion here, it's like we get some mean reversion in price. Doesn't mean that's not going to disturb trend. Like, so I guess what I'm trying to say is that it's completely plausible that we get a little bit of a down move after what we had on Friday. So the hit rate there, if in scenarios where IJ is greater than -7.5, so that's basically saying that, okay, the hit rate's 63%. So we're risking 1.4% to make 1.65% in the short. Okay, that's not the complete scenario. The complete scenario is where this BL is equal to -1, and I see ES at 39.24.5 right now. It's creeping up in our 39.26. Yeah, this is not great, but it's overnight trading right now, so that's fine. Okay, if we factor in IJ, that yield curve volatility metric, that's basically saying ranges should not expand too much. Ranges, I have like a speech impediment. Ranges should not expand too much. On top of that, BL at BL equals 1 because we had that massive rally on Friday, so we expect that to be 1. And then we had the flip for BQ from 1 to -1. Okay, all those things are basically saying that we expect a return of about -0.7%, and the hit rate improves to 71.5%. So the catch here is that there's a low sample. It's the historical sample size is too small, so I can't simulate on the parameters that we extract from that sample. So it's not statistically significant. So I can't make a decision based on the simulation of this distribution of this scenario. So that's why that's that's happening quite a bit. Like all these scenarios that we identified, they're really rare. Like the model hasn't seen these scenarios very much, and that's why it's kind of really difficult for me to decide here what to do. That's why I want to be really nimble. I think we're in this place right now where it's not overly, obvious as to what the market's going to do. So, I wanted to keep this short. It's about 15 minutes right now. Yeah. So anyway, the model is a bit indecisive, but we lean slightly negative returns for tomorrow. Again, I think the last thing I want to say in summary is, okay, maintain a short here from 39.26, but cover that short on any weakness. Okay, I'm bidding 39.08 right now. Honestly, if I wake up tomorrow morning and we're not there, like I'm getting out, right? And anything below 38.91 we should be flat. Honestly, anything below 38.91. And then we just got to see what's going on here, because there's a chance that this range-bound activity, this range-bound nature of ES, like I'm looking at the chart right now, like between December 16th till now, I mean, it's like a sine curve. Like it's just going up and down, up and down, up and down between like 39.40 and 3800. That's kind of a big range, but I'm worried that we're gonna get a breakout, right? And I don't want to be short on that breakout. And the breakout doesn't make any sense. Okay, the breakout makes no sense. Let's just be clear about that. There's no reason for stocks to be rallying because of unemployment number. All right, there's no reason to reprice stocks on the unemployment number, CPI number, even the CPI number. Okay, if you could, there's multiple narratives there. You could say CPI means recession. If it comes in weak, it means recession. You could say, oh, it comes in weak, the Fed's going to pivot. No, they're not going to pivot. They're going to stay high or higher or much higher than we've been over the past 10 years, at least, for a little while, because they want to make sure that inflation is dead. So there's no like trading information there. But people, I don't know what it is. I mean, people or machines or something causes. A lot of it, I think, is positioning. Like there's offside. People get offside, and options activity. I think there was massive one day to expiration options volume on last Friday that was driving. So again, you get all these dealers selling these calls. They got to hedge them. And so they're buying futures. You get this gigantic move, and they're buying futures into the move. So that pushes things up. Now, when there's no more buying to be done, that's when things just kind of fall. And they don't even need to fall on high volume. They just kind of fill in, right? So we'll see what happens. I mean, to me, that seems like the plausible scenario. But there's nothing fundamental that's saying, oh, stocks are cheap here, that we need to take stocks much higher. That's my opinion. If something changes, I'm always up to changing my opinion on that. But that's the way I see it right now. For now, I think that there's stuff going on in the market that could bully prices one way or the other. I don't want to get caught in kind of the whipsawing. I want to be in the right side of the whipsawing. If I see that prices are going to break out above 39.40 and our CI indicator goes beyond zero, I'm stopping out of the position and reassessing. It's too early in the year to go to lose too much money, right? You don't want to start out the year in the hole. A lot of factors here at play, and I've talked about this before, but I think like we're still in this holiday trading kind of environment. Like there isn't much in the market yet to fundamentally price like where stocks should be. I think right now what we're seeing is just a lot of high frequency activity, a lot of options driven activity, one day to expiration. Like, who are these guys? Just a bunch of algos or retail traders. There's nothing there that says, oh yeah, that volume, that order flow should dictate the price. There's nothing there that says that. So let's just be clear about that. But again, we have to trade the market that we have. So if I see that, you know, there's things in the model that are saying, hey, this what we thought is wrong and we got to get out, That's fine. We'll get back in at a better price. Or if it comes off, we'll get long if we have to, right? So let's just, for now, let's just cap it at about 20 minutes here. Just check out the trade plan. If you see anything there is, you know, you want some more information on or questions, just let me know. Send me a message, right? And I'll do my best. Obviously, anything proprietary I can't reveal, but other than that, you know, just let me know. And I'll talk to you guys later. Have a nice night, and have a good day trading tomorrow. All right, bye.